Hi, everyone. Welcome back to RICS Monitor, CP's quarterly podcast series that tracks sentiment toward real estate across the globe. I'm Laura Valean. What makes this quarter especially interesting is that the recovery signals are getting stronger in some places, but so are the contradictions. US office demand is improving. Europe's outlook is turning more positive despite worsening credit conditions. And the Middle East is showing both one of the sharpest corrections and some of the strongest pockets of resilience. As usual, we'll explore the results of the latest RICS reports with Tarrant Parsons, Head of Market Analytics at the Royal Institution of Chartered Surveyors in London. Hi, Tarrant. Welcome back.
Hi, thanks for having me.
So at a high level, the second quarter seems more constructive than the first in parts of the market, but it's still uneven. What's the main story you see across your latest reports?
Yeah, it would be fair to say a slightly better picture is coming through this quarter compared to last, although, of course, the risks around the geopolitical situation are extremely elevated still. But in terms of our data, the headline global index that we produced, it picked up a little bit. It's now sitting close to neutral, so not especially strong, but not particularly weak either, right in that kind of middle zone. And interestingly, it has retraced all of the blip that we saw from last quarter. If you look underneath that, I think there's a fair amount of rotation between markets that's kind of underway now. So the Americas really has established a lead now as a region, strengthening further. I think I'd say Europe has improved from a fairly weak base, but it's the Middle East and Africa that has lost quite significant ground compared to the really robust results that we were reporting for the past several years. And of course, that's understandable given the conflict and disruption that has caused. And then Asia Pacific is still a bit of a drag on the global aggregate, although parts of the region are a little bit firmer. And I'd say perhaps the most encouraging sign overall, when we ask contributors where they think the market sits in the cycle, the early upturn kind of category is now the largest single response globally, and that wasn't the case going back one quarter. So again, that supports the idea of a tentative improvement in Q2.
Let's dive deeper into North America since that seems to look firmer this quarter. As you said, both the US and Canada are improving. Is this the clearest sign of recovery among the regions covered in this quarter's reports?
Yeah, looking at the numbers, yes, it is the firmest picture we have. I think the US has strengthened again, and Canada has kind of come back into positive territory. So the recovery narrative there is starting, and I think importantly, the improvements that we're seeing are showing up on both the occupier and investor sides rather than just one of them. Of course, you can point out some pockets of weakness in both markets, particularly in Canada, but the overall feedback we're getting does signal a positive trend in activity that is gaining traction, sentiment's improving, and North America is certainly the region posting the strongest results at this point in time, and it appears to have the most optimistic near-term outlook out of all the kind of broad areas that we cover.
And actually, one of the most surprising bright spots is the US office market. Occupier demand is at a post-pandemic high there. What's driving that improvement, and does it apply beyond top-tier assets?
I think a few things have come together. So attendance patterns have settled at higher levels, much higher levels than the post-COVID lows following some mandates to bring people back into the office. So I think
Mhm.
that means occupiers now have a clearer sense of how much space they actually need, and potentially that's unlocked decisions that were on hold before. I think employment growth in office using sectors has performed much better than people were perhaps expecting. And then also the supply side matters there too. So there's not been that much new space completed over the past couple of years. So I think the market, certainly for better quality buildings, has tightened up quite noticeably. On whether this kind of stronger narrative extends beyond that kind of top tier, partially where landlords are kind of willing to invest in the buildings and improve its features, then if they do that, they will likely see a better demand backdrop. But I think it is fairly kind of a narrow band. I think the genuinely poorer quality stock isn't really participating in this upturn in the same way, and there aren't convincing signs as yet that this is going to change.
So prime and secondary expectations continue to diverge, especially in the US office market. Are we still talking about a cyclical flight to quality, or has this become a permanent reset in how investors and occupiers value office space?
I think it's an element of both, but I think that the balance has shifted. So ordinarily, when a cycle turns, you'd expect the gap between the best and perhaps kind of slightly poorer quality assets, you'd expect that gap to narrow as risk appetite kind of improves. That's the normal pattern. But what's notable here is that that hasn't occurred. I think the gap in expectations has kind of stayed wide or even kind of widened, even though overall sentiment has improved. And to me, that says the structural component now outweighs the cyclical one. I think the drivers behind it aren't going away anytime soon either. So occupiers really are prioritizing quality because they're using space differently and because they need to offer staff more to attract them to come in. And of course, the regulatory and kind of energy performance requirements coming through that older buildings simply can't meet without significant spend. That's a factor. So I wouldn't say necessarily it's totally permanent, but I don't think it's something that is going to reverse if interest rates were to come down, for example.
Speaking of interest rates, the US is showing stronger occupier and investor momentum even as credit conditions have become less accommodative. How sustainable is that combination?
Yeah, it can probably hold for a little while. And so the reasons why that could happen is I think the occupier side isn't really credit dependent in the same way. So tenant demand is more strongly correlated with kind of headline GDP growth, employment growth, obviously strategies of corporates, leasing events. So I think that momentum can continue fairly independently within reason, of course. And then on the investment side, at the moment, I think a good amount of what's being transacted is perhaps being funded with higher equity. So I think activity can keep going even when traditional bank lending is looking a little bit more restrictive. I think where it becomes a problem is if, the deteriorating outlook for credit conditions persists, further ahead into next year. Development activity in particular is really difficult to push through without an accommodating credit environment and kind of there's going to be quite significant refinancing volumes over the next 18 months or so. So I think it's this stronger activity is sustainable in the short term, but less so if the financing backdrop doesn't kind of improve or were to get worse over the next 12 months or 2 years.
Right. Let's go further north and talk about Canada, which returned its first positive headline sentiment reading since 2023, but foreign investment inquiries remain negative. What's improving domestically and what's still keeping overseas capital cautious?
Yeah, so domestically, the interest rate picture has helped. I'm talking about the fact that borrowing costs have come down meaningfully from the peak that we saw a few years ago, and that has fed through into values stabilizing. I think that gives domestic buyers a bit more confidence to kind of to invest. On the overseas side, I think the hesitancy it was quite understandable. Trade policy uncertainty is the obvious cause, and Canada isn't unique in facing that, but it's particularly exposed given how integrated the economy is with the United States. So that's one factor. I also think there's a bit of a timing element with cross-border capital. It tends to move later in the cycle than domestic capital. So I think it needs to see that recovery is becoming established. Now that looks like it is coming through, but it's just kind of the beginning right now. So I wouldn't read the kind of foreign inquiries read data as a judgment of the kind of Canadian fundamentals. It's just more a reflection of where we are in the sequence right now.
Right. Let's move on to Europe, where the headline sentiment index improved modestly, but the report says the credit backdrop continues to deteriorate. How should we interpret that tension?
Yeah, I'd interpret it fairly cautiously. So the headline improvement in Europe, it is kind of real, but it's coming from a low base. So, and a good deal of the markets there are becoming less negative rather than turning genuinely positive. I think France and the UK are good examples to look at. So both have improved to some extent from the readings that were very poor in previous quarters, especially that's the case for France. And so you need to see this improving narrative become established before you can call it a real genuine recovery. Of course, there are also some more upbeat markets across the continent, such as Spain. Poland saw a real improvement as well this quarter, but many of the larger markets are still displaying overall quite underwhelming or subdued results, even if they have improved from the lows over the past couple of years.
One thing you warned about last quarter was the fact that weaker credit conditions could eventually feed through into investment inquiries. In the second quarter, investment inquiries in Europe flattened. Is that lag now materializing?
It's consistent with it, I would say. So the relationship between those two series has historically been reliable, with the credit reading leading investment inquiries by, I think, roughly 2 quarters. So that flattening in inquiries that you mentioned there, it is about what you would expect to see if the credit tightening from earlier in the year is kind of working its way through. I would stop short of calling it kind of conclusive or on 1 quarter's data. A flat reading isn't quite a deteriorating one, and it is possible that it settles here rather than turning down further. But it is the thing to watch most closely in the next survey. If inquiries start to fall away while the credit conditions indicator remains negative and actually were to dip further into negative territory, then I would say the outlook for activity would certainly appear to be one of kind of decline further out.
And even as current credit conditions worsen, forward-looking expectations in Europe turned more positive. Are respondents betting that this financing squeeze is just temporary?
I think that's largely what is happening. So contributors are kind of looking through the current position to where they expect rates and financing costs to be in 12 months. And I think the assumption embedded in those responses is that this squeeze that we've seen softens or relaxes somewhat. And that's not an unreasonable view, but it does rest on the kind of inflation picture behaving, and the energy price situation over the past few months has made that quite unpredictable. I mean, even within the past quarter, the situation around the war has been so erratic, with at times the deal looking like it was imminent, and then re-escalation of hostilities, and the oil market has seen huge volatility on the back of this. So I think people's views on the impacts of all of this on inflation and interest rates are subject to change very quickly. But during Q2, there did appear to be a sense that this would begin to kind of relax a little bit, perhaps by the end of the year.
You mentioned earlier Poland and Spain as being among the top performers in Europe. And then at the bottom of that spectrum, we can see France, Austria, Germany. How could we explain that widening gap between these countries?
I think it's mostly a story of economic growth with some domestic policy laid over the top. So Spain and Poland both have much better economic momentum at the moment. And in Spain's case, you've got the tailwind from very strong tourism spend and reforms that were also pushed through after the last major economic downturn there. Poland has really seen some accelerating economic growth over the recent quarters. That's despite the more challenging global backdrop to all of this. And then at the other end, I think France has had a really prolonged period of political uncertainty, and that just makes committing capital more difficult. Alongside that, structurally, the office market there just seems to have more of a supply issue compared to other locations, excess supply I'm talking about. I think Germany is dealing with some structural adjustments that will take time to work through. But I also note that Germany, it had appeared to be turning less negative prior to the Middle East conflict really hitting energy markets. But that seems to be influencing commercial real estate sentiment there. To a greater extent than elsewhere in Europe. So that has come as more of a setback for Germany.
Meanwhile, the MEA report shows the regional sentiment index turning negative, largely because of the UAE. How significant is the UAE reversal, and what does it tell us about geopolitical exposure in commercial real estate?
Yeah, it is very significant, and mainly because where the data has the position of the data before. So the UAE had been posting some of the strongest readings anywhere in the survey. That's consistently, for a sustained period. So a
Right.
move of the size that we've seen is a meaningful change in tone rather than a minor adjustment. And what it tells us more broadly, I think the UAE is quite a useful kind of case study because the things that have made it such a strong performer are also the things that are kind of most exposed to this sort of disruption. So the economy is built around being a trade and logistics hub. A very large share of what moves in and out passes through the Strait of Hormuz. And so once transit becomes uncertain, you get kind of shipping, war risk insurance, that those costs rise almost immediately, and that flows through into construction inputs, into the cost of just doing business more generally. You've also seen uh, tourism has been affected, partly due to kind of airspace restrictions and partly through visitors simply deferring plans. The channel I think that matters the most for real estate, certainly longer term, is population. So occupier demand, residential demand. Across the UAE that's been really underpinned by sustained inward migration. And if companies start delaying decisions on regional headquarters or individuals hold off relocating, that demand slows quite quickly. So it isn't purely sentiment that's been impacted here. Some of the underlying drivers have genuinely been disrupted. So these readings are to be taken seriously, but hopefully it is a temporary wobble, and those kind of headwinds will begin to fade. But that's dependent on some kind of positive resolution.
So you'd say this is just a short, sharp correction, not the beginning of a more prolonged reset.
Yeah, I think the combination of the feedback that we're getting in the data actually points to that. So if our contributors thought this was more of a permanent change in the market, you'd expect the forward-looking expectations that we have to have turned negative as well, alongside the decline in investment inquiries. That hasn't been the case. So the way I would read it is that the disruption is seen at this point in time as temporary rather than a kind of longer term structural. The fundamentals have taken a knock, as we were discussing, but I think the view coming through is that if the situation settles, and we can't really predict that, but if that were to happen, then the positive drivers would reassert themselves, and that would kind of strengthen demand across the market. Now, whether that proves to be right, as I say, it entirely depends how long this conflict goes on for. The shorter the
Yes.
disruption, I would, as I say, expect activity to return reasonably quickly, given how strong the underlying position was before all this. I mean, if it persists well into next year, then I think you're going to then see a situation where deferred decisions start to be turn into cancelled ones, and it would be more of a kind of genuine correction if that were to kind of take place rather than a pause. But it's all still up in the air at the moment.
Yeah, yeah. And meanwhile, Saudi Arabia, South Africa, Uganda, Zimbabwe all show pockets of resilience or even growth. What should listeners take away from the contrast between the UAE correction and the stronger readings elsewhere in MEA?
Yeah, mainly the Middle East and Africa is, of course, a very diverse market. The regional aggregate can be quite misleading, especially for the smaller or less established commercial real estate markets out there across the region. So I think the African nations in the survey are really driven by domestic factors, so their own credit and inflation conditions, and by demand that's coming from local occupiers and buyers rather than international capital. So in a way, it's much less exposed to what's happening in the Gulf. I think Saudi Arabia is a slightly different case. So the feedback, the results there, it has softened, but that is from an exceptionally strong run. But looking at the numbers on underlying activity, they remain quite solid, and I think that's linked to how successful they have been in rerouting some of their exports as well. So a little bit of a different situation to the UAE. So the takeaway I would kind of offer is that the regional averages, they can be skewed by the bigger markets, particularly this one, and what we're seeing from the headline numbers won't always describe what contributors are actually experiencing throughout all parts of the region, as I mentioned, particularly one as diverse as the Middle East and Africa.
And looking ahead to the next quarter, what would convince you that this is becoming a durable commercial real estate recovery, and what would signal that geopolitics, credit conditions, asset quality bifurcation are still holding back the market?
Yeah, for me, it simply comes down to inflation and interest rate, the picture around that, more than anything, particularly specific to real estate at this point. I think the improvement in expectations that we've seen this quarter is essentially a bet that the energy-driven pickup in inflation throughout this year so far proves to be temporary and perhaps shallower than initially feared, and that central banks are able to carry on easing for the most part, perhaps from the start of next year. Now, if that were to play out, I think I'd be reasonably confident that this recovery narrative becomes more sustainable, more durable. But the obvious risk is a further escalation in the Middle East. Continued disruption to energy markets would intensify concerns around inflation. Of course, it's then going to stoke further secondary effects in kind of labour markets potentially, or food inflation. They're going to start to contribute to greater difficulties of central banks in enabling them to cut rates further down the line. So that's the huge risk for the market. I think trade policy is another one. I think the uncertainty there has been weighing on cross-border flows for a while now, but if we were to see some further clarity, that might help. So if we get through, I'd say, the next couple of quarters without a further shock, and with inflation not running ahead of expectations, I think the recovery in that scenario could well broaden out. If we do see further setbacks, though, in terms of the geopolitical backdrop, then I think we're probably looking at another period of the market moving sideways at best, or at worst, a renewed period or spell of activity declining.
Yeah, we'll see. Thank you so much for joining me again, Tarrant, and for sharing all these insights with our listeners.
Thank you.
Thank you for listening. If you enjoyed this episode, please take a moment to rate and review CPE Podcasts on your favorite podcast platform. It really helps others discover us. And be sure to visit cpexecutive.com for the latest commercial real estate news, trend stories, and insights from industry leaders. Till next time.